Hello everyone, I'm Shekhar from Momentum Lab. This video is a continuation to the previous video. In my previous video, I discussed about the different factor indices as published by NSE, and we have seen the last 20 years of data and try to rank them based on certain parameters and come up with a top 5 list. Now, most of these top 5 factor indices are from momentum, and some of them are a combination of momentum and quality. Now, as an extension to the previous video, in this video, I want to see, is there any merit in combining different factors and see if we can produce or generate a strategy which performs even better than the current single factor indices. Now, please bear in mind that there are already a couple of multi-factor indices published by NSE. We have covered those as well. And among the multi-factor indices, we have seen two feature in the top 5. That is Momentum Quality 100 from the mid-small cap universe, and as well as Momentum Quality 100 from the small cap universe. Now, that is the context. Let's see which different types of combinations of factors yield better results or performances. In fact, is there even a need to create such multi-factor indices also? We'll be discussing. Now, before we do different combinations of factors, first let's quickly recap of what we have discussed last time. So let me show you with an example of one particular factor. So we've taken mid-small cap 400, momentum quality 100. And then what we've done is we have calculated the 3-year CAGR for any given day. And then we have calculated the rolling returns, rolling 3-year CAGR for the strategy. Same way, we have also calculated the 3-year Nifty returns. And then we have done a subtraction of the strategy minus the Nifty returns. So this way we are getting 3-year rolling return alpha or 3-year rolling return of excess returns. Now this excess returns we have plotted. Now this distribution of excess returns is what we have taken as a key part in our calculations or analyzing different factor indices. Now what we have done within this distribution, we have seen the percentage of values which are falling above zero. And we are calling that as the percentage of outperformance. If more number of the values within the excess distribution are lying towards the right side of the zero value, then we are saying it is outperforming, and we are giving higher weightage to this particular feature. The second thing that we're doing is within this distribution, we are seeing the 25th percentile. From the bottom, we are seeing the 25th percentile, and we are seeing how far is it from the 0th value. If it is greater than 0, it is good for us. If it is less than 0, it is not good for us. And we are giving weightage to this value. If the bottom 25th percentile is lying above 0, then it is good for us, because even the unluckiest investor who has invested in this particular factor will still reap some benefits if they stay invested for at least 3 years. And then we also take into consideration like the average rolling return, which is nothing but where does the median or mean value lie around. So if you see, most of our analysis is centered around the distribution of the excess returns. We take 3 parameters. One, the mean. Second, where is the 25th percentile lying? And third, what percentage of the values of this distribution are greater than 0. Apart from this, we also take other parameters like the volatility into consideration, and then finally get this ranking. Now, as I mentioned, since the central part of our entire analysis is the excess returns, now let's use this distribution further in our analysis today also and see how can we construct multi-factor portfolios. Now, this is the context of the previous discussion. Now, what I've done is I've calculated the excess returns of all the different strategies which are available. Totally, there are 18 different strategies. I have calculated the all excess returns since 2008 till 2024 onwards. We have 16 years of data. Now, within the 16 years of data, the next thing that I wanted to do was, if I end up calculating or doing combinations of 2 different strategies, it will take a lot of time. There can be more than 150 unique combinations that are possible. Now, to eliminate some of the redundant strategies, what we can do is we can do a correlation and see which of these strategies behave in the same way, so that we can omit them, and we are interested in only those strategies which are having no correlation or very low or in fact negative correlation. So let me share that correlation graph with you. So this is the correlation matrix of factor excess returns. So you see all the 18 factors here and also the 18 factors here. And the factor correlation with itself will always be 1, and hence this diagonal is 1. Now, factors which are exhibiting high correlation are marked in the dark red color. Factors which are exhibiting very less excess return correlation are represented in the dark blue color. The ones which have very low or minimal correlation are in light blue to light yellow color. Now, by glancing this, we can eliminate some of the obvious ones. Like, for example, This quadrant, if you see, this is a quadrant of dark red color because it is a correlation between momentum and alpha among itself. So if you want to take a deeper look at this correlation matrix, you can take a screenshot of this, or what I'll be doing is I'll be writing a detailed blog on my Medium and Substack, and you can subscribe to those blogs. The links will be provided in the YouTube description so that you can do a detailed study on these analysis. So let me pick four different combinations from this correlation matrix. And these four I'm picking in such a way that this will give you an idea of the direction I'm going in to identify the best factors to combine. So first we'll take those factors which exhibit the least or negative correlation. That is Nifty 200 value 30 and Nifty 100 alpha 30. That's one. The second is we'll take two strategies based on momentum. One is Nifty 200 momentum 30 with Nifty 200 value 30, as well as Nifty 200 momentum 30 with Nifty 200 quality 30. So that since we already know that momentum as a strategy works really well, so we want to see what kind of strategies can we complement with momentum. So for that, we have seen within the Nifty 200 momentum 30, these two seem to be least correlated. That is value and quality. So we have taken these two. So totally so far we have taken three. One is value with alpha. Second is momentum with value. Third is momentum with quality. Now the leftover is low vol. So let's take something with low volatility as well. So we'll pick up the ones Nifty alpha 50 with Nifty 100 low volatility 30. So this way we have covered all the different factors with some of the other combinations. Now we can construct a multi-factor portfolio in three different ways. The first way is called as double sort. Now I'll explain with the help of an example. So let's say our universe is Nifty 500 and you want to filter out top 50 stocks which have both momentum and low volatility as characteristics. So what to do? You first sort all these 500 stocks based on low volatility and pick top 200 stocks which have very least volatile or which are less volatile. Now among these 200 stocks, you then sort based on momentum ranking and you pick the top 50 stocks. Now this way you're able to construct a portfolio which has both the factors, which is momentum and low volatility. This is called as double sort. Unfortunately, we'll not be able to create such indices with the available factors provided by NSE. So that is out of scope. Now we are only left with second and third. The second option is called as combination. In combination, I again give an example. Let's say you have the universe of Nifty 500. In Nifty 500, you want to sort or you want to pick top 50 stocks which have momentum, which are also low volatile and which are having good quality characteristics. Now what to do? You give a rank to each of these factors and assign that rank to that stock. Now a stock has a particular momentum rank, a particular low volatility rank, and a particular quality rank. You give equiweightage to all these three factors and you calculate a combined rank. Now based on the combined rank, you sort and you pick the top 50 stocks. This is called as combination. And precisely this is what NSE does when they create multi-factor indices. You might have already seen a couple of multi-factor indices earlier, right? The momentum quality 100 or alpha low volatility, alpha quality value low volatility. These are all done based on the same principle of combination. Now let's take a look at the third approach, which is the barbell. I'll give the example for the same Nifty 500 universe, and we want to construct a multi-factor portfolio which has both momentum and low volatility. Now what we do is we want to take top 50 stocks which are exhibiting low volatility as well as momentum. Now among this 500, I'll sort all these stocks based on momentum, and I'll pick the top 25 stocks which are in high momentum, and I'll put as part of my portfolio. Now same way, among these top 500 stocks, I'll sort them by low volatility, and I'll pick the top 25 stocks which are least volatile, and I'll put them in my portfolio. Now this portfolio has both the factors in purest form, momentum and low volatility. So notice the difference between barbell and combination. In barbell, we are picking the best of the both worlds in the purest sense. Whereas in combination, we are making some kind of a arrangement which is like a jack of all trades but master of none. So we are picking those stocks which exhibit some characteristics of momentum, some characteristics of quality, some characteristics of low volatility, and then trying to pick those in our portfolios. So and hence, a combination is different from barbell, and barbell is different from double sort. Now we are going to look in our examples the multi-factor strategies based on barbell approach. So let's take a look at that. Now let's take a look at the first multi-factor barbell approach that we're going to create, which is value plus alpha. So the index that we're going to take specifically is Nifty 200 value 30 plus Nifty 100 alpha 30. We'll combine these two and create a new strategy and see how is it performing. Now, I wanted to show how am I calculating this combination so that if someone wants to try, it will be easier for them to do so. So first, I'll take all the values of the strategy that I want to add. First, I wanted to add Nifty 100 alpha 30. I have the date and total return index from the NSE website. And from there on, I've calculated some derived metrics like the daily percentage change and the NAV, max drawdown, 3-year rolling returns, etc. The same way I've calculated the values of Nifty 200 value 30, its NAV, its daily change, and 3-year rolling returns. Now, I've calculated the combination of alpha and value by giving 50% weightage to each of these NAVs. So in my combined NAV, you see that each NAV gets 50% weightage, that is value gets 50% weightage and alpha gets 50% weightage, and hence the final combination or combo NAV that's how it is calculated. Now, same way for this combo NAV, I again calculate its daily percentage change, NAV, 3-year rolling returns. Now, once I get the 3-year rolling returns, what I'll do is I'll subtract the 3-year rolling returns of the combination NAV with the Nifty 50 NAV to get the excess returns and the distribution of excess returns. That's how it looks like. Now, one thing that I've noticed, I wanted to show us that in all of these excess return distributions of combo NAVs, whether it be value plus alpha, momentum plus quality, or value plus momentum, or low volatility plus alpha, I've seen that this distribution is not normal. It is a bimodal distribution, meaning it has two distinct peaks. It usually means that it has been juxtaposed by two normal distributions. And because of this nature of these distributions, what I've done was I have tried to see which market regime was producing which alpha. To explain that, let's take the case of value and alpha. You see that when you combine value and alpha, value is in red color, alpha is in blue color, and the combination is in yellow color. This is the graph that I'm referring to. Now you see value outperformed from 2008 onwards till 2016. And from 2016 onwards, value took a backseat and alpha started to perform. The same was the case with even momentum and quality. You see that momentum is in blue color, quality is in red color. Quality performed well from 2008 onwards till 2016. The red color was above the blue color line. From 2016 onwards, the flip happened. The blue colored line started to outperform and the red colored line started to underperform. So this was a peculiar thing that I've noticed, that between 2008 to 2016 and 2016 to 2024, there was a definite market shift. And I wanted to see or plot the excess return distribution for different market regimes. So I've written a small Python code. This basically helps us plot the same factor return distribution, but in such a manner that you see between two different market regimes. Let's say in 2008 to 2016, you see what is the excess returns distribution, and between 2016 to 2024, you see it in red color. And if there's a combination of both the regimes, you see that the same values are lying, then you see it in dark red. So this way it will help you identify quickly from which time period was this alpha generated. Was it generated during 2008 to 2016 onwards or 2016 to 2024 onwards? Now that is the base effort that I've done. Now let's go on and see the analysis. The first multi-factor combination that we did was value plus alpha. For value, I've taken Nifty 200 value 30 as the index. For alpha, I've taken Nifty 100 alpha 30. It is 50-50 combination. We also see that its correlation is the least negatively correlated at minus 4.46. So that's the reason I've taken this this is the first combination. Now you see that the alpha is in blue color, value is in red color. Yellow is the combination of alpha and value, whereas green color is of the Nifty 50. Like I mentioned, between 2008 to 2016, value did perform well. Alpha underperformed the Nifty 50. And after 2016 onwards, alpha performed well, whereas value underperformed both alpha as well as Nifty 50. So that's the switch that we have seen. Now let's see the distributions of the excess returns of value, alpha, and the combination, all three. When we put it in this format, we can clearly visualize how is the distribution in a combined fashion and as well as in the individual factors. Now, the first thing that I want to mention is that value has a 50-50 split of excess returns. Meaning, in the last 20 years, 50% of the times it underperformed Nifty 50, and 50% of the times it overperformed Nifty 50. That's a big drag on any combinations that we do. In fact, that's the reason value itself is at the bottom of the rankings in general, because most of the times it hasn't performed, and that's the main thing that we can see first. That's about the value. Second thing is that many people have in fact asked me about alpha also, that if alpha is similar to momentum, why is alpha not featuring in the top ranks? The main thing that I noticed is that alpha's distribution, especially in 2016 to 2024, is really good. Most of its distribution of excess returns is in the positive quadrant or positive side. The problem comes during the time period of 2008 to 2016, where the alpha's excess returns distribution are centered towards the left side, meaning it had underperformed Nifty 50 severely during that phase. You can also see the quantum is also pretty huge. From -10 to -15%. That was the quantum of underperformance of Nifty Alpha during 2008 to 2016. Thereby, if you combine the overall 20 years period, you see that Nifty Alpha index has overperformed or outperformed the Nifty 50 by 73% of the times. If we in fact remove the 2008 to 2016 period, it might have done much better. That can also be seen in this chart. Look at the blue colored line of Alpha. Alpha did really well from 2005 to 2008 onwards, and during the downturn, it stayed above Nifty 50 as well. But 2009 onwards till 2016, the blue colored line of Alpha was below the Nifty 50. That is something peculiar. I wanted to understand what was the reason for Alpha underperforming for so long, for 7 good years, and then again it started to outperform the Nifty 50. So that explains why Alpha has been an underperformer compared to momentum. Now let's see what happens when you combine value and alpha. If you combine value and alpha, you see that the distribution is not moving towards right. Ideally, we want the distribution to move towards right if we combine any two strategies. If the distribution move towards right, then three things happen. One, the mean or the average rolling returns or average excess rolling returns will move towards right. The outperformance percentage will move, will improve, and also the bottom 25 percentile will also go up. So all three things happen if the distribution moves towards the right. But when we combine value and alpha, this is the excess distribution that we have seen. It is not moving towards the right. We'll see the stats here. We see that the outperformance is at 66%, better than value, but less than the alpha. And also the bottom 25 percentile is at -1.67, better than value, which was very bad at -6.44, and tad lower than alpha, which was at -0.73. It is at -1.67. And whenever we combine any two strategies, the values will lie between this. It will get sandwiched between these two numbers. So if you take CAGR, 3-year rolling returns, max drawdown volatility, or Sharpe ratio, the combination is in between. But the key two things that I'm looking at are these two. Whenever we combine any two strategies, the combination should be better than these two individual strategies. If the combination is worse than any one strategy, then what is the need for me to go to the combination? In fact, I'm better off just going with the better strategy. In this case, it is alpha. If you look at any of the parameters, alpha is still better than the combination. So even though alpha and value are negatively correlated, but then that benefit of negative correlation is not translating when we combine these two. Let's take a look at the next combination, which is value and momentum. Now, first I'll show the graph. By the way, this graph that I'm presenting is in logarithmic fashion. So when I mean logarithmic, is that the scale jumps abruptly, because the scale is designed in such a way that this distance is not, let's say from 100 to 200 NAV, it is not equal to 100, because you see from 200 to 400, the distance is 200. But rather it counts as if you move from 100 to 200, it is 100%. 200 to 400, it is again 100%. So the jump is constant here, or the percentage jump, not the actual difference of NAV. Now, in the logarithmic curve, we see a graph, we see that the momentum is in blue color line, value is in red colored line, the orange colored line is the combination of these two, Nifty is in green color. The correlation that we see between value and momentum is -0.2. For momentum, we have taken Nifty 200, momentum 30, and for value, we have taken Nifty 200, value 30. So in this, we see that the value has performed well between 2009 to 2000. At least 2014-15 onwards. And from there on, momentum picked up. And while momentum picked up, value lagged considerably, the momentum. And in fact, it also lagged even the Nifty 50 index for good part of 2018 to 2023, 5 years. and then recently again it started to move up. So this is about Nifty, value, and momentum. Let's see the distribution of their excess returns, value separately, momentum separately, and combined separately. As we have seen in the earlier case also, a value, it has 50-50 split in the excess return distribution. Look at the distribution of momentum in both the regimes, 2018 to 2008 to 16, which is in blue color, as well as in 2016 to 2024 in red color. In both of these regimes, the momentum distribution is right skewed, meaning it is present in the right quadrant. And hence it is more consistent as a strategy compared to value or alpha. Momentum is more consistent because in both the regimes, it was present on the right side of this distribution towards or right side towards this 0% line, meaning it successfully bet Nifty 50 since 2008 onwards till now. So that's one takeaway that we can see of heavy reliance or heavy skewness of momentum distribution curve towards the right. When you combine value and momentum and see the final combination, you see that benefits are not getting translated into. You see that whatever mass that momentum had, or in terms of distribution towards its right, is not present here. It is getting eaten up by the value, because value has such a drag that it pulls up values of momentum also towards its left, and thereby you get something which is mediocre. Let's see the values to make sense. So the outperformance, when you combine momentum with value, falls down to 80%. The bottom 25 percentile falls from 2.06% to 1.27%. And on rest of the other parameters also, it gets sandwiched between momentum and value. Again, as I mentioned, these more than these numbers, I'm interested in these two, because if the distribution of the excess returns shifts towards right, then I have more probability that this strategy works. And if the bottom 25 percentile also moves towards right, it means I have even higher surety that this is the excess returns that I'm going to get if I stay for 3 years. So instead of the exact specific CAGR or the max total or volatility, I'm looking at how far or how better can the distribution move towards the right. So again, we see that even when adding value and momentum, this has not been translated into a better combination. In fact, if you see, this combination is worse than momentum. So we are better off just investing in momentum than doing a combination of momentum plus value. The third strategy is combination of low vol plus alpha. Now for low vol, we're taking the index as Nifty 100 low volatility 30, and for alpha, we're taking Nifty 500 alpha 50. Now the correlation coefficient between these two strategies, excess returns, is minus 0.21. Now in the graph, you see that the NAV of low vol is in blue color and the NAV of alpha is in red color. The NAV of the competition is in yellow color and the NAV of Nifty 50 is in green color. Low vol comprehensively bet Nifty 50 since inception, especially since 2008. It has never had a situation where it touched the Nifty 50 line, and the strategy of low vol itself is better than Nifty 50. And if you see alpha had its share of underperformance from 2008 onwards till 2015, as you've seen in the earlier strategy also. But from 2015 onwards, it started to do better than Nifty 50. Now, alpha tried to do better than low vol in recent times. That is especially from 2021 onwards. The red color took over the blue colored line. So that's about how these different strategies performed. Let's see the distribution of their excess returns. We're already aware how alpha look like. 75% of the excess returns are positive and 25% of the excess returns are negative. That too, we see that the majority of this lag is because of the time period from 2009 to 2015 onwards. During that point of time, alpha lagged pretty badly, and that's the reason to see this negative in the distribution, negative values in the distribution graph. When compared to alpha, low vol is much tightly spaced. Because of the scaling, it might not be looking evident. Let me show you the scaling of alpha. Alpha spans from minus 15% to plus 15%. The range spans minus 15 to 15%, whereas low vol is from minus 0.25 to 12.5%. And in fact, it is more dense towards its central point. And low vol did well in both the regimes. You see that the blue colored line as well as the red colored line are skewed towards the right. In both 2008 to 2016, as well as 2016 to 2024, it did well, low vol. When you combine alpha plus low vol, you see that the negative is getting reduced. Earlier, it used to be at minus 15 of alpha. Now, the max range spans up to minus 10%, and it gets abruptly cut at minus 5% because the low vol is pulling up the alpha strategies excess returns towards the positive side. And you see in the outperformance percentage also, the combination is similar to what alpha is. In fact, better than alpha is 76%. Whereas the bottom 25 percentile is 0.24%, which is less than low vol, but better than alpha. So this strategy is somewhat better than the previous two strategies. It is getting sandwiched exactly and is not too far away from both of these best strategies. Now let's take a look at the final one, which is the quality and momentum. For momentum, I've taken Nifty 200 momentum 30 as the index. For quality, I've taken Nifty 200 quality 30 as the index. The correlation coefficient between these two is minus 0.2. Now momentum is in blue color, whereas quality is in red color. Combination is in yellow and Nifty is in green color. Now you see that during the times of 2008 to 2016, the red colored line, which is quality, did well as compared to momentum or also as compared to the Nifty 50. From 2016 onwards, momentum took over and momentum did well. During these two time periods, both momentum and quality did well than the green color line, which is Nifty 50. So this is one stark difference between the rest of the other three strategies that I showed and compared to momentum and quality. Momentum and quality, they both have a yin and yang, meaning they have this negative correlation, but the negative correlation of their excess returns is in such a fashion that none of them go below Nifty 50 at any point of time during the last 16 years. They've always stayed above Nifty 50, but they have this switching off or switching on between these two strategies. Now notice the same thing with the others like Nifty low vol plus alpha. Low vol was always above Nifty, the green color line, but alpha was below the green color line, which is Nifty 50, thereby pulling the overall excess returns. And that's what can be seen. The excess returns were pulled towards the negative side because low vol alpha did not fare well for good 5-7 years. Now, if you see value plus momentum, same thing. Value was above the Nifty 50 till 2016, but there were some periods of underperformance, especially from 2019 onwards till 2023. Even during 2006 to 2009 onwards, also value was not doing better than Nifty 50. In general, value did only 50% times better. So value itself is a drag on the other factor. Now, momentum did well across the time frame from 2008 onwards till 2020. That's why it could take some of the losses of value and still had a decent distribution curve of 80%. Whereas if you see the combination of value and alpha, value underperformed. First of all, alpha underperformed from 2009 to 2016. And again, value underperformed from 2019 to 2023. So these two strategies, even though they were severely or negatively correlated, the negative correlation is such a way that they ended up underperforming Nifty 50 for good 5-6 years during their journey. So thereby pulling down the excess returns on alpha. Now that is not the case with momentum and quality. Both momentum and quality, even though they had this alternating behavior, you observe this red colored line and blue colored line, they were always above the Nifty 50. So from the time period 2009 to 2016 onwards, the quality was doing well. Quality was doing well, which is way above the Nifty 50. In fact, momentum was also doing good. It was never below the Nifty 50. And after the switch that happened in 2016, 2017 onwards, momentum did really well than Nifty 50, and also the quality also did decently well, and it did not go below the Nifty 50. You can see the distribution here, which clearly spells out quality during the phase 2008 to 2016 had clearly outperformed. You see the blue color lines there; they show clear outperformance, and they're tilted towards the right. During the period 2016 to 2024, it had equal performance and to a slight skewness towards the right. And you see a big mean centered around the 0% during the 2016 to 2024. So quality performed really well during one market regime, and in the other market regime, it did equally well. So thereby, majority of the times, it did decently well. And anyhow, we have seen that momentum did considerably well in both the phases, right? And thereby, you see that the combination of these two, the distribution skews or moves towards the right, and there are very less number of values or data points in the negative side. In fact, it gets cut off at minus 4%. If you see the bottom 25 percentile, it is at 2.57%, which is better than the momentum 25 percentile value 2.06, as well as better than the quality minus 0.14. And also the outperformance days or outperformance is at 93%, which is again better than 86% of momentum and 73% of quality. The rest of the values are sandwiched between these two factors, momentum and quality. Now, the other difference that we see from the rest three strategies and momentum and quality is that the sum is greater than the parts. And this combination is more robust because it gives a higher probability for someone to take home a positive alpha after investing for 3 years. And the quantum is also pretty good. The quantum, which is bottom 25 percentile, 2.5%, has jumped even from the momentum's 2.06%, and much above the qualities minus 0.14%. Now, this is what I call as pure synergy, where this is the prime example of diversification. In the other three cases, it was not diversification, it was actually diversification. We are taking one bad apple and putting it in a basket of good apples, and we're expecting some magic to happen in terms of diversification, but it is not the case because value is such a drag that it is pulling the entire good basket down. In quality, it is not the case. Quality itself is doing well, and momentum anyhow is a great strategy. There's again a duality between momentum and quality. So even if, let's say, one takes a backseat, still other is pulling off, and thereby both of them are pulling the alpha much ahead than the individual strategies. And this is not something new, I think, that we have observed, at least I've observed. Maybe the brains at NSC or the mutual funds who are asking, or you're creating indices or strategies based on this index might have already observed. And that's the reason we see multiple momentum and qualities combination strategies. You already have two. One is Nifty 400 mid small cap, momentum quality 100. You also have small cap 250, momentum quality 100. So I think the reason for momentum quality is that of this phenomenon that is happening, which is the duality. And the duality is in such a way that both of them individually are good. And when you combine, it becomes great. So that's the synergy that you're looking at if someone wants to diversify and build a multi-factor strategy. Or if someone doesn't want to do that, after seeing this insight, straight away the mid-quality combined indices are also there. So that's the key takeaway that I had, that all the roads, after doing the analysis, are leading towards momentum. And if you add quality to it, either in a barbell fashion or in a combination fashion, that's even great. So to summarize, we have done a couple of things in this video. First, I've showed you guys the correlation matrix of different factors. The correlation is between the excess returns that these factors generated over and above Nifty 50. And from these, we have picked up some of these strategies which had negative or low correlation. Now, among these strategies, the way we have constructed these strategies was by a barbell method. We also discussed about the other types of strategies that can be combined. One is combination, second is double sort, and third is barbell. And we have seen 4 different types of strategies. And in those, we have seen combinations of value and alpha, value momentum, low vol and alpha, and lastly, momentum and quality. First, we have demonstrated that value is a drag on whenever you combine it with any factor, it drags it. And we also seen that volatility as a strategy itself is really good. And alpha also looked good, especially during the phase 2016 to 2024 onwards. But the peculiarity of alpha is that it had a severe drawdown, that to be a big quantum from 2008 to 2016 onwards. Thereby, if you look at the overall 20 years of data, it is pulling down the entire strategies. But if someone is just looking at the last 10 years of data, maybe alpha might definitely come up in the rankings. And whenever we're looking at the combinations, we wanted to see the distribution of excess returns move towards the right, so that we have more probability of making alpha in the longer run. So with that as a metric, we saw which strategies had higher outperformance than its individual parts, as well as we also saw which strategies had the bottom 25 percentile number move up or do better than the individual parts. And in all the 3 cases, the combination was worse than the individuals. Only in the case of quality plus momentum, the sum was more than the individual parts. And I also shown the reason for that is that both of them, alpha, momentum and quality, had significant overperformance over and above Nifty 50 since 2008 onwards. And even though they had a yin and yang between them, that is alternating switching on and switching off between them, they still do outperform the Nifty 50. Thereby, the alpha only keeps on compounding. And we also seen that the distribution between within the quality is distinct, like as shown in this 2 bimodal distribution. In 2008 to 2016, it had a phenomenal run. In 2016 to 24 onwards, it had a decent enough run. It had equal underperformances and equal overperformances. That's it. That's the whole summary about multi-factor. Finally, all roads lead to momentum, and quality, if it is there, it is great. And momentum quality, again, there are 2 different approaches. You can choose a combination approach. I think that's what Nifty and NSE have been trying to do when they create more and more momentum and quality indices. Or you can also take a barbell approach of having a focus on pure momentum factor and quality factor and combine your strategies and do the factor investing. I'm not a SEBI registered advisor. This is purely an analysis done by a normal retail trader like you. If I were to invest, how would I approach? Thanks a lot, guys. Have a nice day. I'll be sharing all the links in the YouTube description in some time. Thank you.